While artificial intelligence has been a dominant investing theme, there are other lesser-known parts of the markets that have been catching the eye of investors. Joining us now to discuss is TD Asset Management's Himanshu Sharma. Himanshu, great to have you on the program with us.
Thank you.
This is your first time doing a full show with us. Give us a brief overview of your role at TD.
Sure. Thanks for having me here, Greg. I work as portfolio manager at TD Asset Management, and I manage global equities and US equity portfolios. And in addition, I also manage a publicly traded infrastructure fund.
All right, so let's start talking infrastructure then. That's why we have you here. The AI theme, obviously it dominates, and every time NVIDIA's on deck to report earnings, it's all we talk about. But there are other, you say, interesting sectors in the market. Take me through them.
Sure, exactly. So obviously we do know all about AI, but the area that we are focusing on and which we find interesting are the marine ports. So marine ports, just like any other infrastructure asset, say toll roads or airports, they are also monopolies, certainly local monopolies. And the operators there have long-term concession contracts to manage the ports. So again, gives them a level of stability. And just like any other infrastructure asset, very high cost, very high fixed cost business. So volumes are really important for this business. And historically, what we have seen is that with the rise of global GDP, the volumes only have grown over time. So that underpins fairly strong thesis for these names. More recently, what we have seen is that with COVID and also with geopolitical tensions with China, what has happened is that people realized that for some of this stuff, maybe there was only one single source. So there is an attempt to develop redundancy in the system. So which actually means that there is more manufacturing activity now coming up in Southeast Asia, which means that previously, suppose say if there was a container going from China to US directly, now it is going to Vietnam and then from there maybe to one or more countries and then going to US. So it is lifting the volumes for the ports in that region because of this reason. Now this trend is started only over the past few years, and we think this is something that could go on for some time to come.
That's interesting. I have more touch points along the journey. People are familiar with the idea of marine ports, seaports, but they might know the details. You say there's actually two types of big ports out there. What's the difference between the two?
Sure, exactly. So the two type of ports would be the transshipment ports and the O&D ports, origin and destination ports. The transshipment ports, so if you want to think and visualize a port, basically in the transshipment ports, so Colombo would be an example of that, or Singapore. Basically, there are large ships and that would unload the cargo, and this cargo would go on to other vessels on the port. It will not enter the local region or economy. So those are transshipment ports. When it comes to O&D ports, origin and destination ports, the stuff gets unloaded from the ship, and then it is for that particular region or that particular economy. So the stuff will get unloaded and then loaded onto train, onto the rails or onto the trucks, and then it goes into the economy. So the benefit for the port operators when it comes to origin and destination is that they have more to offer to the ships, and hence they can charge a little bit more in terms of the value, and this gives them a higher margin. The other thing is, so one example of that kind of a port would be, say, Long Beach in Los Angeles. So the stuff is coming in for the local economy, and then stuff is going out also from that place. The other benefit of O&D is that the location is also very important because the stuff is going for that local economy. So this gives also a stability of volumes for such ports. So those are the two different type of ports.
Two different types. You have an example. You mentioned Long Beach there. You have another example of a company based in the Philippines that fits with this trend. Who are they?
Yes, exactly. So the name of the company is International Container Terminal. It is a company based in Philippines, but they have almost about 30 ports globally, mostly in emerging markets, and most of their ports are of this O&D nature, origin and destination. So the company is a direct beneficiary of this China Plus One, the development of new manufacturing facilities elsewhere. So the redundancy which we are seeing. At the same time, the company also they buy underperforming ports and they increase the efficiency, and that's how they drive the pricing and the margins. So those are the two major thesis that underlies this particular name.
So you have some bullish trends here for these seaports and the particular ones that you're outlining. What about some of the risks, though, for these companies?
Sure. The risk, generally speaking, for the ports, the risk is the volume, for sure. If the volumes were to go down for any reason, it could be because of recession. It could also be because what we are seeing right now because of the Iran war. From Europe to Asia, the previous route would have been, say, through Suez Canal, but now everyone is going through around Africa, through Cape of Good Hope. So obviously it creates losers and winners with respect to the ports. For international container terminals specifically, given that majority of their ports are located in emerging markets, so in, say, Africa, Latin America, and Asia, there is political risk. There is a risk that the contracts may get renegotiated ad hoc. So that is a risk. And then with, say, emerging markets, the foreign exchange, the currency is also always a risk. So those are the two risks I would highlight, besides the volume risk with ICT.